Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over loans between shareholders and C corporations. And we're going to be doing that the SuperfastCPA CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam, and we will teach you how to be effective and efficient with your studying. Again, it's only 1 hour, it is free, so make sure you go check that out. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in this video, whereas Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. Alright, here we are at question 1. Jane, a shareholder, loans $50,000 to Smith Inc., a C corporation, at the beginning of the year with an interest rate of 1%. The applicable federal rate, or the AFR, at that time is 3%. Calculate the imputed interest for the year. Okay, you've probably dealt with this a little bit before, so it might not be too difficult to figure this out, and this is kind of going to be the base of what we go through in the rest of the video. So if you want, pause the video to do the calculation. If not, let's go to the answer. All right, the answer is $1,000 of imputed interest, so it's pretty easy to figure out. You take the applicable federal rate, so the rate that you should be charging at, and that's $1,500 in this case, 50,000 times 3%. And then the actual interest paid was at the stated rate, and that's $50,000 times 1%. So you take the difference, $1,500 less $500, and that gives you the imputed interest of $1,000. Now, what does that mean? For Jane, who's the lender, and in the shareholder in this case, but remember, this is specifically for the lender, Jane must report the $1,000 of imputed interest as income on her personal tax returns. This is considered income earned because, for tax purposes, she is treated as having received this interest from Smith Inc. despite it not actually being paid. And for the borrower, or in this case Smith Inc., they can deduct the $1,000 of imputed interest as an expense on its corporate tax returns. This allows the corporation to reflect the true cost of borrowing, adjusting for the fact that it has effectively incurred this interest expense. Basically, imputed interest for the lender means that they should have received that money, so even if they didn't, the IRS is going to tax the lender as if they had received that additional interest. And for the borrower, they are going to be able to deduct the interest as if they had actually paid it. So that's the basics of imputed interest. That's considered a below market rate loan, by the way. And again, that's what we're going to be looking at a lot in this video. So let's go to the next question. Okay, here is question 2. ABC Corp., a C corporation, loans $100,000 to one of its shareholders, John. The loan agreement specifies an annual interest rate of 3%. The applicable federal rate at the time of the loan is 5%. Assuming the loan was issued on July 1st, how much interest is payable by John for the remainder of the current year? Okay, so this is asking how much interest is John having to pay. So make sure you pay attention to that. I feel like you could probably figure it out just based off of what we saw before. If you want, go ahead and pause the video and do the calculation to the best of your abilities. And when you're ready, come back, we'll look at it together. Okay, the answer is $1,500. So to find the interest payable for the remainder of the current year, we have to calculate the total annual interest based on the interest rate specified in the loan agreement and then adjust for the portion of the year the loan is outstanding. Despite the applicable federal rate being higher at 5%, the interest calculation uses the rate agreed upon in the loan contract, which is 3%. So we have to first calculate the annual interest by multiplying the principal amount by the interest rate, resulting in $3,000. And again, we're using the stated interest rate here. Since the loan spans only half the year from July 1st to December 31st, only half of that annual interest applies, which amounts to $1,500. Thus, John needs to pay $1,500 in interest for the remainder of the current year. Now, this is how much he actually paid. This is the interest payable. The interest payable is based off of the annual interest rate stated in the loan. But just remember, in this case, John would have also imputed interest. If you think about it, the AFR was 5%. That means that it was $5,000, but it was only half the year, so $2,500. So John only paid $1,500, but the IRS is going to tax and allow deductions on the full $2,500 that they think should have happened based off of the AFR. So just remember, the interest payable is just what is stated in the loan, but imputed interest comes in when we take into consideration the AFR and the taxes. All right, let's go to the next question. Okay, here is question 3. Alice, a shareholder, loans $100,000 to ABC Corp., a C corporation, with an interest rate of 2% per year. The current applicable federal rate for such loans is 5%. ABC Corp. pays the loan off that same year. Assuming the loan was paid at the start of the year and the interest is calculated annually, how much interest income must the IRS tax for this below market rate loan by the end of the year? Okay, so this is a little bit different. they paid off the whole loan in 1 year, and we need to figure out how much interest income the IRS is going to tax. Now, again, you could probably figure this out based on what we've learned so far. If not, that's okay. Let's go ahead and look at the answer together. Okay, the answer is $5,000, and that should make sense based off what we've seen so far. It might be a little bit confusing, but let's go ahead and read through it. In this case, the interest income that must be taxed by the IRS is the amount calculated using the applicable federal rate, not the lower interest rate actually agreed upon in the loan contract. So again, that's how much is going to be taxed. There might be imputed interest in there, and there might be the actual interest paid, but as far as the IRS is concerned, they are going to tax at the AFR. So $5,000 is going to be the amount of interest income that is taxed, even if that wasn't the amount that was actually paid. And this also applies in this situation or situations like this where the loan was paid off all in the same year. The AFR is still taken into account for the taxable interest income. All right, let's go to the next question. All right, here we are at question 4. In January 2023, DEF Corp., a C corporation, lent $15,000 to its shareholder, Susan, at an interest rate of 1% per annum when the applicable federal rate was 4%. By the end of the year, Susan has repaid $6,000 of the principal, reducing the outstanding loan balance to $9,000. How do the below market rate loan rules apply to this loan at the end of 2023? All right, so this is the first time where we're learning the actual numerical rules for below market rate loans. So you may not really know how this works. That's okay. Let's dive straight into the answer to learn the rules here. Okay, the answer is that the below market rate loan rules still apply for the entire year because the loan originated at more than $10,000. So let's read through this. The IRS rules specify that below market rate loan considerations do not apply to loans under $10,000. However, this doesn't apply for term loans if the initial amount of the loan exceeds $10,000 at any point, meaning it was originally subject to the below market rate rules. By the way, if you noticed, it says term loans right here. Term is kind of more what we typically think of when we think of loans. But I do want to throw out there that there also may be something you see on the exam called demand loans. Demand loans are basically, they don't have necessarily a specific amount of time. The interest is just calculated each year based off of the amount that's left. And the lender can demand the full amount of the loan at any time. Usually this is used in these situations where there's C corporations and shareholders, and they're kind of trying to do a quick loan, and then they'll pay it off soon. So you might see demand loans or term loans. So for term loans, kind of more typical loans, if the initial amount exceeds $10,000 at any point, and it was a below market rate loan, we can look at this scenario and see that even though Susan repaid part of the loan and reduced the balance to $9,000, the rules continue to apply for the entire year. This is because the original loan amount exceeded the $10,000 threshold. Therefore, despite the reduced balance, the initial conditions under which the loan was issued, specifically its amount, determine the application of the below market rate loan rules. So the typical rules are if a loan is below $10,000, even if the AFR was higher than the stated interest rate, it's not a below market rate loan. And that typically holds true even in the case of like gift loans or demand loans. But when it comes to term loans, again, a more typical loan that you're used to seeing, if the loan started over $10,000 and then eventually the loan is paid off and is below $10,000, it's still counted as a below market rate loan. All right, that was one more rule, so let's go to the next question. All right, here is question 5. Mike, a shareholder, receives a $20,000 loan from XYZ Corp., a C corporation where he holds a significant share with a nominal interest of 0.5% per annum, whereas the applicable federal rate is 3%. The IRS reviews the loan and decides to treat it as a distribution. How is this loan treated for tax purposes for Mike? Okay, so the IRS took a look at this loan and they considered it a distribution. What does that mean for Mike? If you have an idea, that's great. If not, let's go ahead and look at the answer together. All right, the loan is treated as ordinary income to Mike. So let's read through this. When a C corporation issues a loan to a shareholder with terms significantly favorable compared to the market, such as a much lower interest rate than the AFR, the IRS may not view it merely as a loan. Instead, it can be classified as either a constructive dividend or additional compensation instead of a loan, depending on the circumstances surrounding the transaction, such as Mike's role within the company and whether he provides services that could justify such treatment. This can cause the loan to be counted as ordinary income for Mike for tax purposes. So this is something that shareholders and C corporations need to be careful of. They can't give something that is so blatantly compensation and they're just trying to get around some of the other rules. If the IRS sees something that's too beneficial, they may consider it just a normal distribution or compensation, and then it would be taxed as ordinary income instead of being a loan, which would be more favorable for the shareholder. So something that they need to think about. We learned a lot in just 5 questions. Before we go any further, we're going to do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up throughout the questions that are obviously important. You know, things like, ooh, I keep seeing imputed interest. I keep seeing these rules about below market rate loans. I keep seeing this and that. And you know that it's obviously important because your review course is trying to teach you it. So you write it down as a pillar topic so that you know it for later and for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here are the pillar topics. First, for the imputed interest is the difference between the interest calculated at the applicable federal rate and the interest payable at the stated rate. It's recognized as taxable income for the lender and a deductible expense for the borrower. Imputed interest is taxed even if no actual monetary exchange occurred, provided the stated interest rate is below the AFR. And I didn't really talk about this very much, but obviously if the stated interest rate is the same as the AFR or higher than the AFR, then this below market rate rules doesn't apply. It doesn't matter at that point. But when it does come to below market rate loans, below market rate loan rules apply to loans greater than $10,000, where the interest charged is lower than the AFR, including term loans paid down below this threshold but originally exceeding it. Now, if the IRS classifies a shareholder's loan from a C corporation as a distribution or compensation, it is taxed as ordinary income to the shareholder instead of being that beneficial loan. And finally, the actual interest payment obligation remains at the stated rate per the loan agreement, regardless of adjustments for imputed interest calculations. So if it ever asks you, what is the actual interest paid or interest payable, that is whatever was in the loan, the stated interest rate. So don't get confused by the imputed interest and the AFR in that situation if it's only asking for the interest payable. All right, those are the pillar topics for this video. And before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, we will teach you how to study effectively and efficiently so that you pass your exams without wasting months and years of your time. If you liked going through these 5 questions, remember that Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. Thank you so much for watching. I hope this was helpful, and I will see you in the next video.